Hello, everybody. Welcome to Thursday. The S&P 500 was down a little bit more than 0.1% today. Kind of an accomplishment, actually. It was down quite a bit more in the morning. We had a nice bounce yesterday off of support. And we don't normally get what I call a V recovery, where we get that bounce and it just comes straight back. Those have happened, but they're usually in more powerfully upward moving markets than what we're dealing with here. You get more of a W or a U-shaped recovery if you're going to have something. I'm not convinced yet that we're at the level that's going to attract enough buyers. We're definitely holding up. We've kind of hit that, 4,200 level for 3 days in a row. The more you hit it, the more you start to dry up that support at that level. And there's more support below that too. And oftentimes if you're going to have a reversal, you kind of have this like reversal day where the market is down a bunch in the morning and then comes all the way back. We had a little bit of that today. But if you really want to see a big one, you look at last year, October 13th. That was a really nice example of a reversal day where it was down substantially. And then I think it actually ended up by the end of the day. So we did have a change in our signals. We're back to double reds on stock and double reds on the bonds also. And so, again, that's to be expected with the market, coming down from its highs at the end of July, as far as that goes. Now, the stock market for us, we're still, holding the positions. We move them when the 50-day moving average is above the 200-day moving average. We just rotate on the list. We have a cut line on the list. If it falls below the cut line, we go back to the top and buy that and sell the other one. When things are below the 50-day moving average, like they are, the 50-day moving average is below the 200-day moving average, like they are in the bond market, we have a totally different, more aggressive motion. We'll sell, most of our positions and go to the top of the list. And the top of the list in the bond market has been treasury bill type of holdings. And so we've been in that for quite a while. So it's different for each market. The 50-day moving average is still quite a bit above the 200-day moving average here. And really, that's the main problem that we're dealing with. We can talk about all the other issues, what's happening with the bond market, what's happening with, the House Speaker situation, all these. But really, the key thing that I see is that the market got very much ahead of itself earlier this year, peaking out at the end of July. The stretch between the 200-day moving average and the 50-day moving average was really high. It's still pretty high. And so you're not going to have a huge run. Again, if you have a rubber band and you stretch it out and it comes back a little, it's not that easy to then make a huge run upward and have this big explosive rally. You got to kind of let that come together and they absorb. And you can do that by just going sideways for a little while and what have you. So we'll see, how things go as far as that goes. You can stretch quite high or low. Usually low, you actually can stretch farther because fear is a more dominant emotion than greed. Those are the two biggies that kind of drive the markets. That's why you see charts kind of going up slowly and then falling quickly, because greed is not as powerful as fear. But altogether, I think, today is a fine day. I did like the recovery that we had today. Some support came in. We got down to, I think, 42.22 during the day, and then market kind of came back and such too. So there's definitely support, just like we thought, right here, holding us up. We'll see how this plays out, but look forward to talking tomorrow. I do my live show on YouTube, Talk Money with Tom. You can look it up. It's 12:15 to 1 o'clock. And I do a summary at the beginning of that of kind of what I see happening, with the stock market. So, I think this will be a really interesting week. And tomorrow is the big day, because tomorrow is the day that we have the jobs report. Could be one of the best jobs reports for the year in terms of, most interesting. And expected 170,000 new jobs created last month. If it comes out hot, the market probably, falls because worried about inflation. If it comes out really low, market could fall worried about recession. So we're kind of looking for that right around 170 would be good. We'll see what happens. That comes out in the morning. We did get the, unemployment data today. First time unemployment comes out every week. That was up a bit more than expected. Usually that's a bad thing, but in an inflationary environment, that's actually a good thing here. And then we also got the private payroll report from ADP. We had the fewest number of jobs added on the private sector since the beginning of the year, last month. And again, Normally that would be a bad thing, but in this particular case, it's a good thing in this inflationary environment. So things aren't terrible there. Tomorrow will be interesting to see how that report comes out. Sometimes they don't line up perfectly with the other reports that have been coming out this week, but hopefully that'll show some softening of the labor market at least a little bit, because the Federal Reserve is going to key on this for their next meeting in November, on November 1st. So look forward to seeing you tomorrow. Thank you very much.